Get Rich Education is brought to you by Mid-South Homebuyers and thelandgeek.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education. This is episode 40. I'm your host, Keith Weinhold. You're listening to GRE from wherever you are, the brownstones on Broad Street bisecting historic Philadelphia, and in your earbuds at the Houston Street subway station in Manhattan, out to the idyllic West Coast at the Santa Monica Pier in California, and the beautiful breadbasket country in Iowa, and everywhere else in between, and in 130 foreign nations. You're listening to the show with the highest return on time invested, and I really appreciate that you're here. Well, since I'm constantly asking the question here, how can I make you more successful than me, faster than me? I thought one way to make it easier for you to position your financial life to qualify for a mortgage loan is to bring a mortgage loan officer onto the show, and that's what I've done for you today. And not just anybody, but a senior mortgage loan officer that specializes in investor loans and has skin in the game himself because he invests in income real estate himself. And I've looked up today's guest for my investment needs myself after I met him in person in Dallas, Texas years ago. You already know that real estate is the investment that has made more ordinary people wealthy than anything else. But, there's a big myth that persists out there that holds some people back from investing in real estate, and that is it takes a lot of money to invest in real estate, so I guess I can't do it. Well, that's not true. We've discussed a number of ways to invest in real estate without using much of your own money. We've discussed real estate syndication. Then there's a vehicle like Land Geek Mark Podolsky's program. And, then the most common way to invest in real estate with using less of your own money is learning how to best position yourself for the best mortgage loan terms. Well, really, what's the motivation for obtaining a mortgage loan? Well, even if you can pay cash for a property, you likely want a loan. You know what? Whenever a celebrity with a high net worth obtains a loan, especially a mortgage loan, it seems to make news. You remember a few years ago, Facebook's Mark Zuckerberg, he's got a $40 billion net worth, yet he made news back a few years ago specifically because he obtained a loan for his home. And the public asked, why in the world does a billionaire need a loan? Well, the public just isn't financially educated. Really, the better question to ask is, when one can borrow at interest rates at or below the rate of inflation, how can one afford not to get a loan, okay? What's the sense of tying up a large chunk of your money in one property when you can have it freed up to use for more profitable things? That's another germane question. Well, another question for you is, do you want to own more real estate or less? I'm asking you that now. Do you want to own more real estate in the future or less? If you're a real estate investor for the long term, I want to ask you this too. Do you think real estate values are going to be higher 10 to 20 years from now or lower? You think higher or lower over that longer time horizon? If you think higher, like I do, well, then you want to control more real estate, not less. And you can do that with loans. Okay, now let's touch on the downside a little bit too, okay? If you have, say, 30% equity in a property, and the property loses 30% of its value, you've taken more than a haircut on your equity, then you've got an entire wipeout of your equity position. It's all gone. It's a buzz cut. Or maybe it's, even a head shaved bald, all your equity's gone. But, if you're in the right market, it could hardly matter because you would still have the positive cash flow from the property. So, then maybe we could say that the hair starts growing back then. So, I don't know. I've probably gotten enough mileage out of these hair analogies. So, getting back to mortgages, I'm reminded of a quote I heard from, I don't really remember where, someone from the Rich Dad Group, or maybe it was even GRE's John Collins. And it goes something like this. Debt and taxes make you poor. Understanding debt and taxes make you wealthy. Okay, so we're delving into understanding how to best leverage debt to our advantage today. So just to set this up, before we bring Graham on, I don't want to leave anyone behind here. When a lender discusses LTV, that's a loan-to-value ratio. Think of it basically as the inverse of an equity position, okay? If you put $20,000 down on a property valued at and sold for $100,000, your equity position is 20%, and your LTV, your loan-to-value ratio, is then 80%. If you put 25% down, then your LTV is 75%. So to determine loan-to-value ratio, take 100%, and just subtract out your percent equity, and what's left over is your LTV, your loan-to-value ratio. Now, you can make your own decision, but I choose to leverage higher LTV loans, meaning keeping lower equity positions. All right, because in an appreciating value environment, that makes for greater leverage rates of return, typically more tax benefits as well. There's better liquidity because I have less money tied up in a property of low liquidity. And I've typically got better asset protection because I have less skin in the game that a creditor can go after. All right, plus consider this too. When interest rates continue to defy gravity and be at historic lows just for years like this, well, would I rather borrow 50% of a building's value? Or would I rather borrow 80% of a building's value and have that greater amount tied and locked up to a low interest rate over the long term? Well, I'll take an 80% loan because I want to capture a greater portion of those historically low interest rates as long as the property is projected to provide monthly income after all expenses, which is our cash flow. Our guest today, Graham Parham, is also going to tell us about a new program in case you want to get loans for more than 10 financed properties. Okay, that's kind of something new and exciting. That 10 financed properties threshold was previously pretty difficult to cross over, okay? Well, before we bring Graham on, I want to tell you, basically, make a last call here. I want you to get in, if you want to get in, on International Coffee Farm's to-be-planted parcels and the generous discount that the company founder made exclusively for Get Rich Education listeners. You can buy your own cash-flowing Panama coffee farm parcels. Yes, you can buy as many parcels as you like in half-acre increments that are professionally turnkey managed. I invested in this myself last year. I'm saying it's last call because the $13,000 price per parcel has been reduced to $12,000 just for our listeners only through the end of this month. So if you're listening to this after the 31st, I'm sorry, the generous discount period has expired. But after the 31st, you can still buy them. They're just going to be $13,000, not $12,000. And actually, $13,000 is closer to what I paid for my lots when I bought last year. I found getting in at $13,000 attractive enough with their coffee farm pro forma returns of 13 to 15%. For my full feature interview with International Coffee Farm's founder David Sewell, to learn all about that opportunity, check out episode 28 here. Coffee is the second most traded commodity in the world to oil, and the demand for coffee keeps rising. The population keeps rising. And at the same time, the amount of arable land just keeps decreasing. Hey, I'm pretty bullish on the United States in a lot of ways. There's a lot of great investment opportunity here, but I own several hard assets outside the U.S. I think a good question to ask yourself is, do I really want to have 100% of my hard assets tied up in the greatest debtor nation in the history of the world? It's a totally valid question. So to register for your $1,000 per parcel discount and pay $12K rather than $13K per parcel, all you have to do is send your contact details to coffee@getricheducation.com within the next 2 weeks, and that's it. Send it to coffee@getricheducation.com and you will be registered, and International Coffee Farms will be in touch with you from there. And I look forward to meeting you in person at an upcoming coffee farm tour there in the scenic and beautiful highlands of Western Panama, checking out our coffee farms and seeing how we're improving the lives of the Panama coffee farmers. Well, hey, let's talk to Graham Parham about investor loans for income property. Today, we have with us Senior Loan Officer with Highlands Residential Mortgage in Dallas, Texas, Mr. Graham Parham. Welcome to Get Rich Education.
Hey, Keith. Thanks for having me.
Graham's been doing loans since 1997, and for a long time now, he has specialized in investor loans. In fact, 90% of the loans that Graham helps originate are investor loans, and Graham is an investor himself. So he really understands what you need. So, hey, Graham, before we talk about loans, why don't you talk a little bit about what real estate investing has done for you?
You know, it's interesting. I was doing a lot of loans for a lot of big investors, back in 2000, 2001. And I kept seeing these tax returns come across my desk. And I kind of go, what do these guys know that I don't know? Nothing. They're just doing it. So I decided to jump into it as well back in 2002. And I bought my first one, believe it or not, sight unseen, and bought it from an investor. And once I got one under my belt, I ended up buying like 8 that next probably 10, 12 months. After that, I probably, put another 5 or 10 on my belt. And then, of course, the mortgage guidelines changed in 2008, which kind of put the brakes on being able to continue to build my portfolio. But, now that I've got it and I look back, I tell you, I would have never done anything differently. I think it's been a great passive income. It's been a great tax comfortability for my, my overall portfolio. I mean, I highly encourage anybody to take a look at real estate. And we all said, some of the biggest investors and some of the biggest wealth advisors out there, there's always a portion of their portfolio that's in real estate. And I'm 100% in full agreement. And having that real estate on my belt, it's part of my retirement.
So, Graham, I've introduced you as a senior loan officer, but are you a broker or are you not a broker? And what is the difference?
I am a mortgage banker. The company is represented by private mortgages, which we're privately held. The company's been around for several years. As a mortgage banker versus a mortgage broker, the differences are a mortgage broker has the ability to send their loans across town or out of state to several different lenders. Once they do that, they kind of let go of the file itself, and they rely on that company to support the loan with their processing department and their underwriting department, then of course their closing department. The difference between that and a mortgage banker is that all those processes are in-house. As a mortgage banker, we have our own processing, our own underwriting. We actually have our own closing and legal, and we'll actually close the loan in our name with our money. And then, of course, post-close, the loan is sold off just like the rest of the market.
So now, when I started investing in real estate back in 2002, we were in a pretty loose, easy lending environment. And as we know, a lot of the changes that came along around 2008, 2009 have changed some things, and the pendulum went from easy to a difficult lending environment. How would you characterize the lending environment today overall with the difficulty of obtaining a residential mortgage loan?
Back in 2008, the entire industry took a knee jerk. Everybody throttled back significantly. A lot of the lenders shut their doors. It was craziness for at least probably a year and a half to 2 years until it finally kind of settled itself out. I think for the most part, when the government stepped in 2010 and adopted the Dodd-Frank Act, I think their intentions were good, but I think their execution, sometimes if anybody in the mortgage industry would probably question. The reason why they developed it through, the CFPB, which is called the Consumer Financial Protection Bureau, it was also adopted during this administration, and they're kind of running the show. They're the sergeant of arms. They're establishing policy. They're also arbitrating the industry to make sure they're doing things right and make sure that everybody's in compliance. With all the compliances that we're having to adhere to in today's environment, it's taken a lot more effort to get loans done just to make sure that we keep in compliance with all the rules and regulations, because one little mistake can cost the company as well as the individual quite a bit of money in fines. And oddly enough, the CFPB has been out, not necessarily doing a witch hunt, but they have, been suing a lot of folks over the last several years. And, they've pretty much knocked down most of the big boys. Now they're working on the smaller guys. But in 2013, the last shoe, for what it's worth, dropped for the Dodd-Frank Act. And they came up with this thing called ATR, the ability to repay. And that's the key word, or the buzzword in the industry today, is can the lender prove that the borrower truly has the ability to repay? Not only in investment lending, but also in owner-occupied lending. Because if the originator cannot prove that, or should I say they originate the loan and fund the loan, 6 months later, the borrower loses his job. He can always come back and sue the lender and say he didn't have the ability to repay. Now, that's to the extreme of things, but because of that, the industry itself has tightened up so much. We've gone from a quasi-streamlined process from 2008. And then, of course, 2010, we went into a fully documented process. Then we went into an overly documented process. And now we're kind of into the ridiculous phase where, some of the investors are asking for things that you would just never, ever would have asked for, 3-4 years ago. So are we doing loans? Yes. Is it as easy as it used to be? No. But when you get with an originator that understands what it's going to take on the front end, hopefully that prevents, us coming back after it's gone through the underwriting process, say, well, you know what? I think I am going to need that 4th grade report card now that I think about it, So, yeah. And that's where the stupid thing comes in, because the underwriters, they're the last stroke of the straw. They're the last stamp on the file. And so they want to make sure they have ownership of it as well. And if they can't have everything fully documented in the file, then of course they want to prove it. So it can be challenging from time to time, but we're getting them done.
I've started looking up, Graham, for my own investment property needs about 3 years ago. And just in that time, I've seen a significant amount of change. So I just want to bring up that, this is a rather timely episode. If you're listening to this 3 or 4 years from today, there's a fair chance that a lot of these things may not apply. So, Graham, in one, getting started with an investor loan today, in buying a property to rent that a borrower is not going to live in, what are we looking at for the conventional loan, Fannie, Freddie requirements as far as percent down, reserves, income shown, and so on?
Well, all loans in general, I've always referred to as the 3 C's, the credit, the capacity, and the collateral. The collateral being, of course, the property itself. The capacity, making sure that the borrower itself has enough money to do the transaction and they make enough money to support the loan itself, especially from the standpoint of qualifying ratios. And of course, they want to make sure they have a good credit profile. So really validating those 3 categories is always the first and foremost that all lenders will do. Now, from the standpoint of, on investment lending, since 2008, we've throttled back quite a bit on the down payment requirements, where, before we used to have, 0 down and heartbeat and a signature. Well, that's gone away, of course. But for a single family, if you have less than 4 loans, you can do a minimal down as 20%. And a lot of lenders do have the availability to do 15%. But when you're doing that, you're faced with MI, private mortgage insurance.
Right.
And I've run the numbers backwards and forwards, and it's just not prudent to do a 15% down because you're not saving the money in the long run. So 20% down is always a good one. And then once you achieve 4 loans, you go into the 5 to 10 category, which we refer to as the multi-property category. Then it's a 25% requirement. Now, on the 20% requirement, the credit scores can go as low as 620, okay? And the reserve requirements for a individual transaction for a single family is 6 months on the subject property. That's principal, interest, tax, and insurance times 6. Plus 2 months reserves on any other property that they own, primary residence, second home, or another investment property. When you get to the 5 to 10 category, the credit requirements go from 620 to 720. The down payment requirements, once again, goes from 20 to 25%, but the reserve requirements are a little bit higher. They go for 6 months on all properties owned. So keep that in mind.
Yeah, that becomes a real headwind. So just to clarify for our listeners, that's 6 months PITI on the subject property, meaning the one that you're going to buy, for 1 to 4 properties.
Correct.
And then from 5 to 10, finance properties. Again, we're not talking about a number of loans. It's finance properties. It becomes 6 months reserves on the subject.
Correct.
And 6 months on every property held within one's portfolio as well.
Correct. And a lot of those reserves can be documented with non-liquid funds, like a 401k, a personal IRA, these kind of things that are tax sheltered. We can utilize those documents. Let's say you had 100,000 in IRA will represent that you have 60,000. We'll use 60% of that figure to show that you have those reserves. The only thing that we'll ask for is that you do have the ability to exercise getting that money out immediately. Like a lot of 401ks that may be sponsored by the employer, they are very prohibitive of when you can take that money out. A lot of times it's only for primary residence or for emergency medical purposes, but that's about it. So keep that in mind as well.
And typically the underwriter there that you're working with is looking for the previous 2 pay periods, pay stubs, and the previous 2 years tax returns?
Correct. Typically we want 2 months worth of all asset accounts, 2 years of tax returns. And then, of course, if you've purchased any property after that last tax submittal, then we'd probably want to see, the settlement statement, tax and insurance information on a property that you have purchased. But typically, that's it as far as assets and earnings.
And now, typically, and we're still talking about investment properties here, not primary residences. With the credit scores mentioned, first of all, we mostly talk about a FICO score, FICO, Fair Isaac Company, and then additionally, is the decision not just a blanket yes, no, your rate might depend upon your credit score?
Absolutely. And that's where, since the 2008, that Fannie Mae definitely stepped in and started making some adjustments on the credit scores as it relates to rates. And where you start taking a hit pretty good is when you get below 680. They basically do 20-point increments, 620, 640, 640, 660, so forth and so on. And your highest threshold is 740. So if you have a 740 or higher, you're going to get the optimum rate. And then once again, it gravitates downward. And once again, when you get below the 680, that's when they get a little bit more aggressive. You could probably achieve the same rate, but you may end up having to pay some additional points to get there.
Now one thing that I've actually wondered about this myself, Graham, is say that one might be a little bit lacking on the FICO score or might be a little bit lacking on the reserves, and they need to put 20% down for a property. Now, usually I think a lot of my listeners want to use leverage and want to put less down. However, if they put 30% down rather than 20%, can you make some of those other criteria become more lax?
The 30% will help you in a couple of different ways. Needless to say, as far as the income ratios, the lower the loan amount, the better it's going to ease up on your qualifying ratios. The other thing it'll do is from a 20 to a 25% down, you're going to receive a benefit on the rate. Typically, it's between 3/8 and a half, but a lot of times you'll see definitely a discount on that rate.
A rate discount with a higher down payment.
Correct.
And then to talk about the interest rate in another sense, these days, typically, what are we seeing for interest rate differentials for an investment property above what you'd pay in an interest rate for a primary residence?
Once again, that's typically between 3/8 and a half or even 5/8, depending on the day. But a half usually is about an average, and it's been that way for many, many years.
Okay.
And a lot of people don't understand that. They're out, wanting to buy an investment property, and they're out looking on the internet and seeing all these owner-occupied rates. Well, they never put 2 and 2 together, and that's the wrong way of looking at it.
Right. That's a really important thing to say, because as a listener, if you're checking rates quoted, what you're often seeing quoted by the major banks and by aggregator sites like Mortgage News Daily is a lot of times you are looking for those owner-occupied. You are looking at those primary residence rates. So you got to remember, if Graham quotes you something for an investment property, it's probably going to be higher, just like it would be with any other lender.
Correct.
Hey, something I've been a little bit curious about, Graham. First of all, as we know, things have gotten more stringent in the last 10 years. 10 years ago, it was easier to get a loan. However, you usually would have to pay a higher interest rate. Now you have a higher bar or a higher hurdle that you have to jump over, but if you get there, there's a greater reward for being allowed to pay a lower interest rate, meaning that you might get some better cash flow.
Interest rates are in a very, very favorable position. It's been that way once again since 2008. The government stepped up and tried to keep them as low as they can to keep the economy fueled. Are rates going to go back up? It's kind of hard to tell. If I knew that, needless to say, I'd be living on Wall Street. But I think for the most part, they're going to be maintained for at least another year. We've seen it creep up a little bit since the beginning of the year, but not a whole lot, maybe an eighth quarter at best. But, I've been working with investors that have been investing in real estate since, the early 80s. And they've always said to me, anything below 7% is a great rate on an investment property. And that's true. It really is. So, we're in a great interest rate environment, in the 4s and the 5s. And 10 years ago, you'd have never thought that.
Sure. Back in 2002, when I bought my first fourplex as an owner occupant living in one unit and renting out the other three, I got a mortgage interest rate of 6 3/8%, and that was seen as fantastic.
Absolutely. That was.
A year later, I was refinancing into something lower. I wanted to get rid of that quote-unquote fantastic rate for something better. With that being a real positive in getting a better cash flow for the investor, one thing that seems to come up every once in a while is, are we ever going to see mortgages go longer than 30 years and be able to extend that amortization out? Do you see that as happening anytime soon, or in a tight environment, just little chance?
I personally don't, simply because when the Dodd-Frank Act was put into place, there was a lot of things they throttled back on. Stated income loans. Now, keep in mind, these are loans that are sold to the agencies, okay? This is not to encompass any of the portfolio lenders, anybody that doesn't sell their loans other than Fannie or Freddie. Sometimes they can do their own thing, but that was one of the things that was cut back on because we actually used to have 40-year amortization products available. We had interest-only products available. We had ARM products that had negative amortization available. So we had all kinds of different products, in my opinion, that made sense in a lot of applications, but in a lot of other people's opinion, that it was a detriment to the economy because, when you try to put somebody that can barely afford a loan to begin with or a house to begin with, and you put them into a negative amortization loan, well, they're already, cursed to begin with.
Right.
But from an investor standpoint, it made a lot of sense, especially from an equity play. But as far as the 40-year, I don't think we're going to see that for quite some time.
You're listening to Get Rich Education. Our guest is Highlands Residential Mortgage Loan Officer Graham Parham. More when we come back. I'm your host, Keith Weinhold. Are you looking for a way to build monthly cash flow investing in real estate, but without the typical hassles you hear about? While other people flock to compete in the house flipping and rental property markets, now could be the time to learn migraine-free real estate investing. In business for nearly 15 years, Mark Podolsky, aka the Land Geek, has unlocked the secrets to creating significant passive income by investing in raw, undeveloped land. No renters or tenants, no rodents or termites, no renovations or toilet repairs. Imagine achieving your financial goals without suffering through the constant stress that landlords and house flippers do. For more information, go to thelandgeek.com/GRE.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education with Highlands Residential Mortgage Senior Loan Officer Graham Parham from Dallas, Texas. Graham, what about the debt-to-income ratio? I know that's something that's held back some borrowers from buying a property. How can you advise someone to avoid that?
The DTI has been around forever. The back-end ratios have fluctuated over the years, where some of the Alt-A lenders back before the 08 lending days would allow these DTIs to push up to 50, 60. I've even seen some as high as 70%. And once again, as long as it's approved or it gets approved by the underwriting engine, then they typically will go with it. And the underwriting engines that are now supported in the industry today is supported by the Fannie Mae engine and the Freddie Mac engine. Fannie Mae being desktop underwriter, and of course Freddie Mac being the loan prospector. The majority of our loans that we process is through the Fannie Mae scenario for many, many reasons. But when the Dodd-Frank Act came into play and the ATR limitations came into play, one of the things they stipulated is that they don't want to see the debt to income ratio on the back end go more than 43%. Now, keep in mind the government right now is still running Fannie and Freddie, so they're still in conservatorship, where eventually they'll go back to a private sector. When that happens, then that 43 will be a hard stop. So right now, some of the major lenders, being on a conservative basis, has adopted that 43 as a hard stop back-end ratio, where other lenders are able to go beyond that up to 45, sometimes even close to 50 or beyond, depending on their taste for risk, as well as if the underwriting engine, once again, will support and underwrite the loan. So the DTI is basically a mathematical formula. There's a front-end ratio and a back-end ratio. Your front-end ratio is your housing debt, which you take your principal, interest, tax, and insurance. You divide that into your gross monthly income. The back-end ratio is taking the housing debt plus any other debt that you may have, student loans, car loans, whatever, credit card loans, you name it, and that is lumped on top of the PITI for the subject property, and then that number is divided into your income as well. That supports your back-end ratio. Your back-end ratio is the most important one as far as lenders are concerned, and those are typically the ones who will, have a make or break. But right now, 43 is kind of a good barometer for what it's worth in the industry, but we have the ability to go a little bit beyond that.
Hey, Graham, what about foreign buyers? Foreign buyers that are not U.S. citizens that want to get a conventional loan to buy U.S. income property. What are their options?
Let's just take foreign buyers, not green card, but they live here in the U.S. and they have the right to be here in the U.S. Depending on the type of visa, typically it's a work visa. I've even seen loans get approved with student visas. But for those kind of guys, we really treat them pretty much as a U.S. citizen. We have no problem with them as long as we can prove that visa is going to have a continuation. I believe it is at least for another 3 years. Foreign nationals, people that truly do not live in the U.S., that want to invest in the U.S., that becomes a little bit more challenging. And a lot of your portfolio lenders will have products that allow foreign nationals. Fannie and Freddie just does not support that in. We as a company, we're looking at developing some products right now to possibly support that. I do know we have one right now. It supports owner occupancy, but it doesn't support the non-owner, so we're looking into that as well. We're hoping that we can come up with some really good products that have limited down payments, because typically these products are a 50% down payment program, where if we're trying to develop a program what's going to be like 20-25% down, which is going to be more favorable for the foreign national and the investor to do. I'm hoping we're going to have that this quarter, but stay tuned to your nearest channel. When we get it out, I'll let you know.
Now, one common question I get from investors and those interested in buying investment property is, okay, now how do I structure this? They can put it in an LLC or not put it in an LLC, depending on what sort of asset protection they get. But how does that intersect with how one does loans? And are there some planning considerations around LLC formation, Graham?
Great question. A lot of people that want to get into investment, they want to have peace of mind. They want to have that blanket peace of mind, whether it be through a blanket insurance policy or possibly putting their products into an asset protection tool, whether it be an LLC, an LP, S Corp, whatever the case. And that's fine. I usually support this answer with an on the record, off the record. I can tell you what I do personally, and I can tell you what the majority of my investors will do, but I can also tell you what Fannie Mae will or will not do. As far as me personally, I have asset protection. I do have an LLC. I generate the loan in my name or my wife's name, and then post-close, I will retitle that property into my LLC. Now, what that will do would potentially do a thing called a due on sale or trigger a due on sale clause. Due on sale clause is a part of every loan for both Fannie and Freddie. It's a promulgated document which basically states if you retitle the loan into anything other than your personal name, you have to let us know, and it could potentially trigger the loan to the point where it may come due. Now, off the record, I've personally been doing this for years. I know investors have been doing this for years. I've never seen a note triggered just for simply retitling it. Unless, of course, you want to pick up the phone and call the servicer and say, hey, guess what I'm doing today? And, of course, the other person on the other line that's reading from a script going, well, Mr. So-and-so, I think we may have to call that note.
Right.
But I've never seen that happen. The only time I've ever seen a due on sale, or should I even say a note called due, you stop making the payment. Pretty simple.
Yeah, just to clarify for our listeners, what we're talking about when a lender may call the note due, however, we've never seen it happen, is when an investor attempts to move a property from being titled in their own name and switch it into the LLC name. On paper, the lender can go ahead and just say, you owe the entire loan amount to us immediately. However, I've never seen that happen. Typically, you just switch it without recourse, and I think Graham is telling us that he's had the same observation.
That's correct. One of the things that happens from time to time is when people do start building up their portfolio and they put all their properties into an LLC, and then they see an opportunity on an asset play where they want to, sell a property or two and then graduate those dollars and cents from the equity into more property themselves, going from selling one property to three properties, which typically they'll do through a 1031 exchange. Now, the exchangers, the industry itself is not regulated, so you have to make sure you get with a good exchanger, because a lot of times if you don't, you could have some problems. But most exchangers will allow you to do an exchange as long as the entitlement is the same. So if you have your house that you're selling that's in an LLC, and then you want to buy 3 more residential properties and you come to me to get that loan, I can't give you that loan because Fannie or Freddie does not honor LLC lending. You have to get it into your private name and then, of course, take it out thereafter. Okay, so keep that in mind.
Yeah, so as you can see, there's some real planning considerations around all this with how you're going to structure this and go ahead. Now, off microphone, Graham was telling me about something really exciting for quite a while now. The loans at the best terms that are Fannie Freddie backed, one had a limit where they could only get 10 financed property loans. However, Graham, I think you let me know that we could be looking at a system where one can buy more than 10 properties?
Well, it's a real program. We're launching it hopefully this week, according to management. It will allow us to go beyond the 10 limit and there's no limitations. So if you came to me and you had 30 loans in your portfolio, but you can't, get any more loans, well, I can help you out. The two things that's very important is that the loan limit is a minimum of $100,000. So if in some of these discounted markets, that's not going to work. And also, if you're looking to buy multiples, I can give you multiples, but no greater than 5 more. Okay, because this is a private program itself.
Yeah, that could be a nice option for some people. So, well, Graham, if I have a listener that lives in New York or California and they want to buy investment property in another state, how can you help them with that?
The way it works is I am licensed currently in Texas, Tennessee, and Georgia, and soon to be Florida and California. I currently am working on getting those licenses set up as soon as possible. Like I say, I should have the California in place right away. But I've been doing business in those other 3 states for several years now. I get licensed in those areas that I know where the markets are good and where they're going to need, good lending, because like Memphis and Atlanta, Indianapolis, Dallas, all these are great markets to invest in.
So if there's a lender from New York or California, the state that you are licensed to give loans in, including Texas, Tennessee, and Georgia, which are 3 popular investor states, you can indeed originate loans for residents of New York or Minnesota or California. Is that right?
Correct. Doesn't matter where you live as long as you're investing in that state.
Hey, well, that's great. Well, how can my listeners find out more and get a hold of you directly, Graham?
You can call my toll-free number, which is 855-326-6802, or you can go to my website. It's grahamparham.com. That's GrahamParham.com.
Okay, that sounds great. And listeners, if you have an interest in utilizing Graham, I really recommend it. I've looked him up before for my own needs, and he really has this great, straightforward style, and he'll let you know sooner than later whether qualifying for income properties are going to be a possibility in your situation or whether it won't be. So, hey, thanks so much for coming on and giving us some insight in today's lending environment, Graham. This has been great.
It's my pleasure, Keith. Anytime.
It's always insightful to chat with Graham. So I think there's a few takeaways here. You can have a great credit score, stable income, and an adequate down payment and reserves, but you still need to meet that DTI requirement. And I know that debt to income requirement has prevented a lot of loans from happening. So just to review, figuring out your DTI is simple math, okay? The front end ratio is your monthly housing debt divided by your gross monthly income, all right? Monthly housing debt is PITI, principal, interest, taxes, and insurance. And I believe that would also include any homeowners association dues that you pay as well, okay? And the back end ratio, the back end DTI, it uses those same numbers, but it also adds in any other personal debt that you might have, like car loans, credit cards, student loans. And it's usually that back end one that bites people. And that's where a lot of banks stop at 43% DTI. Some even go to 48%, even 50%. So, okay, we're talking about how you should have 43 to 50% of your gross income to spend on all your debt obligations, okay? I've been an applicant for tons of investor loans in my life, and I swear that when I calculate my DTI myself, I can never come up with the same number that the underwriter does, even though it's an easy calculation. There's just always a number missing or something there. But, here's some strategy to keep your DTI lower, all right? If you're in a situation where, let's say you have some good liquidity and your DTI might be a little bit too high, but you have a car loan of $10,000, but yet that monthly car payment is, say, $400, well, then you can pay off the car loan for just $10K, and that'll totally knock out the monthly car payment of $400, and you've just lowered your DTI. So talk to someone like Graham. He can give you more than just a yes or no answer on whether your situation is going to fly with his underwriter, okay? I mean, unless it's emphatic that you do or you don't qualify. He's going to help, you do what you need to strategically do to increase your chances of obtaining a loan really with as little pain as possible on your part. So get these things in line with someone like Graham before you go looking at property, okay? I mean, Graham is still going to ask you for a number of documents. He has to. Now, you can make Graham part of your team. I've talked at length about how market selection and team selection are even more important than the property. Well, I'm helping you build your team right in front of you today. Now, Graham and I talked off microphone a bit today too. If you rent a room in your home with Airbnb, can you use that income to qualify for investment property and help you lower your DTI? The answer is yes, as long as you're claiming that income on your tax return. Graham and I are both big proponents of using HELOCs, home equity lines of credit. I mean, boy, just consider opening one up if you have adequate equity in a property. I think of a HELOC somewhat as a credit card drawn against a portion of your home equity, but it's better than a credit card. Okay, for one thing, the debt is secured because that property is collateral, so you get a great interest rate, probably 5% or less right now. And you only have to draw against it if you want to. You can pay it down as you want, so your HELOC balance can kind of expand and contract that way. You can get a HELOC on your primary residence and use those funds for investment property or whatever else, really. HELOC interest is typically tax deductible, and it is not for a credit card. And then also with credit cards, you typically have to pay down a portion of the principal with each monthly payment that you make, so that makes your payment a little bit higher. With a HELOC, you typically have interest-only payments, meaning you only have to pay the interest accrued portion, and you have the option each month of paying down any extra principal. So they're more flexible. I've used HELOCs to buy property before, so I have a good idea of how this all works. Now, consider that some people are paying credit card interest rates of 15% plus, and they have available home equity where they could go open a HELOC, transfer some of that credit card debt to the HELOC. So they're going to get all those benefits that I just mentioned. Plus, their monthly payments are now lower, helping their DTI. But, the more obvious benefit of that's just going to bring more cash flow into your life because you're paying less in interest charges. All right, now if you have self-employment income, I know that there might be a temptation to pay yourself a smaller salary or show a loss on your tax return to get a more favorable tax treatment, but think about how showing less income is going to affect your ability to buy investment property. So I think the lesson there is some planning up front based on what your goals are a really prudent thing to do. And, hey, what about this scenario, all right? Say you own 4 single-family homes and you want to buy a 5th one, okay? You want to add another income property. Well, Graham and I just discussed that once you buy your 5th through 10th ones, that you need to use a higher down payment and have a higher credit score. Well, if you have adequate equity in 2 of those 4 homes, you could sell those 2 homes and use the equity to buy a 6-plex. The 6-plex probably has a better cap rate than the 2 single-family homes that you sold anyway, and now you only have 2 homes remaining in that 1 to 4 unit space, all right? That 6-plex doesn't count as a residential mortgage loan because it has 5 or more units, so now you've just opened up space so that next investor single-family home that you buy would only be your 3rd one and not your 5th one. And now you continue to get the favor of the more lenient credit score requirement and lower reserve requirement, and you can put less % down. So, there are a lot of things to consider and plan for. And, I could probably run out in the open field on the microphone on this topic for like 2 hours because I really get interested in these intersections of debt, equity, leverage, financing, and cash flow. All right. I'll probably just naturally keep metering these things out over the episodes. The thing to keep in mind is that I'm not a registered mortgage loan or financial professional of any kind. I've just done a lot of loans. But hey, now you do know a good professional, Graham, and his contact information is in the show notes for you. You know what? I feared that my voice was going to give out today because I just spent part of the afternoon inhaling and exhaling deeply as I was blowing up a bunch of balloons for a 12-year-old's birthday party. Yes, which I never expected to do. My Filipino wife and I attended a 12-year-old's birthday party because she's friends with the parents. Well, there were like 80 people at this party, and I was the only white person there. Everyone else was Filipino. Now, I don't really have a problem with that at all, but the problem was that everyone there was speaking either Tagalog or Ilocano, so after eating lunch and having another 10 minutes after that of feeling culturally isolated and unable to interact with any adults, I ended up blowing up balloons and, acting like a kid for a while. So, hey, on a future show, I'm going to interview a very accomplished guest who has the experience of advising the Obama and Bush administrations about financial literacy. Yes, this guest was appointed to the President's Advisory Council on that topic and served each of those presidents. And you know what? I think I'm going to ask that guest, I'm going to ask which president, President Obama or President Bush, has the sharpest mind for real estate investing. You want me to ask it? I mean, really, how many times can I ask a person that question that's actually qualified to answer it? Hey, we'll see how that discussion goes and feels, but yeah, you know what? I am going to ask that. We'll see what kind of answer I get for you there. Down the road, I'm also going to do that show about how fourplexes can be tremendous wealth builders, along with some landlording tips in there. As you know, the first property I ever bought was a fourplex building where I lived in 1 unit and rented out the other 3, which was a great springboard for my wealth. Maybe episode 44 would be an appropriate number to finally select for that fourplex show. We'll see. Hey, thanks today to Senior Mortgage Loan Officer Graham Parham. On behalf of GRE's developer John Collins, designer Nikon Roy, sound engineer Vidran Jampo, I'm your host Keith Weinhold. We'll see you next week. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.